Welcome back to another weekly update. There'll be one more update coming out on Wednesday, which is 15th of Jan, followed by videos on every Saturday. I'll try and be a little bit more active for the next 2 odd months. I do understand that the market has entered a tricky phase, so I'll do whatever best I can in terms of guiding you through the price action that is playing out. Do follow me on Insta because sometimes I do post out a couple of charts which are of importance. I don't mention whether you should be buying that particular chart or short selling it. But if you'll read my comments, you'll always get a sense of what may come in the market. So this particular video, I won't be sharing a lot of charts because I'm sure by now a lot of you are going through social media handles, already seeing the kind of breakdowns that are happening. But I'll give you a different perspective about what is going on in the market and why you should be in this particular phase focusing less on the noise that is there in the market and focusing more on charts that you could identify for the next maybe 3, 6, 9 or even 12 months. The first lesson you need to learn is to focus on your own game. Now in each lesson I'll be reading excerpt from William O'Neill's book, that is How to Make Money in Stocks, and I'll explain where we are in whatever phase he has mentioned in the respective chapters of the book. I'll be reading some snapshots also, so please be patient because this is very important for you to understand. A Harvard professor once asked his students to do a special report on fish. His scholars went to the library, read books about fish, and then wrote their expositions. But after turning in their papers, the students were shocked when the professor tore them up and threw them in the wastebasket. When they asked him what was wrong with the report, the professor said, "If you want to learn anything about fish, sit in front of a fishbowl and look at fish." He made his students sit and watch fish for hours. Then they rewrote their assignments solely on their observations of the objects themselves. Being a student of the market is like being a student in this professor's class. If you want to learn about market, you must observe and study the major indexes carefully. In doing so, you'll come to recognize when the daily market averages are changing at key turning points such as major market tops and bottoms, and learn to capitalize on this with real knowledge and confidence. Now, this particular excerpt from his book is where he talks about distribution in the market. To be highly accurate in any pursuit, you must observe and analyze the objects themselves carefully. If you want to know about tigers, you need to watch tigers, not the weather, not the vegetation, and not the other animals on the mountain. The reason I've pulled this up is because whether you were tracking markets based on what we discussed in the Market Outlook 2025 video, if you haven't watched that video, please do so. I released it, I think, 1 week before New Year, highlighting a lot of concerns in the market and why market could face a significant pullback and then again a rally within a range. So I'd given a range of about 15-20% for the market in 2025, where a lot of up and down movements would happen, but broadly the markets would be in a range. If you look at the two charts I posted for you on Instagram, this was on 3rd Jan when Bank Nifty was facing a lot of resistance at higher level, lot of distribution candles. And then finally, I think at 50 DMA, this was a bearish engulfing that was forming with deteriorating relative strength. What happened next day was a breakdown in terms of this particular flag. We had a retest of flag, and from this 51,000, we are now already down 2,200. The reason I want to point this out is because focusing on your own game is pivotal for you to do well in the market. I know a lot of you might be put off by what is happening in the stock market, but if you ask me, this is a fantastic phase in market where a lot of new participants who are coming in the market thinking about it as an ATM are getting a reality check. And that reality check is always good for long-term participants of the market, because as the market corrects, the risk reward that you get out of stocks will get in your favor. The way markets were running up and a lot of concerning points that were showing up in terms of GDP data slowing down, FII is pulling out money. This is global in nature. I won't say this is India specific. You will see over time American markets also consolidating, maybe time or price wise. Indian markets are doing the same. If the market went up from 7,000 Nifty to 26,000 Nifty in a period of 4 years, surely it can pull back 10-15%. That is why don't lose focus on the overall context of the market. This pullback is a major pullback playing out in the market. A major pivot is getting formed. But for you as an investor or a trader, your focus has to be on your game. Your game is to study price action on a day-to-day basis and study price and volume alone. No options data, no open interest data, No futures data, no indicators, just study pure price action with respect to 50 DMA and 200 DMA. Believe me, many a times you will be ahead of what is coming in the market. The second lesson that William O'Neill teaches is that don't judge the market too soon. I'll read some excerpts because this is about bull and bear market and how bull markets top out and how bear markets eventually lead to new bull market. Bull and bear markets don't end easily. It takes 2 to 3 tricky pullbacks up or down to fake out or shake out the few remaining speculators. After everyone who can be run in or run out has thrown in the towel, there isn't anyone left to take action in the same market direction. Then the market will finally turn and begin a whole new trend. Most of this is crowd psychology constantly at work. When bull markets usually top out and turn down before a recession sets in. For this reason, looking at economic indicators is a poor way to determine when to buy or sell stocks, and this is not recommended. Yet, some investment firms do this very thing. Again, the reason I've selected this page is because over the period of time, next 3-4 months, you're going to hear a lot of things about interest rates again, about inflation, about growth slowing down, GDP data. But remember, this is cyclical in nature. The lesson that we learned in slide 1. Whatever is happening in India today, it is eventually going to spread out to the world markets also. You're already seeing US markets have begun some kind of price and time correction. So the price action always comes first, and then the news is put into places to justify what is happening in the market. The truth is, I personally don't think a long-term bull market is over. Again, this is my hypothesis. I can be clearly wrong. I will wait for more clarity in the market to decide whether this is a leg that is going to last for the next several months and we're going to see a painful bear market, or this is one of those phases where we have already seen in the past where the markets keep fluctuating, come back to 200 DMA, break it, move down, sentiment is poor, news flow is poor, then we have a sharp reversal on the upside, again downside, a lot of movement below 200 DMA, and over time price again moves higher. If you look at this phase, this is very similar to what is happening today. Today we are at 21,800 on Nifty 500. The way we have closed on Friday, maybe we are heading lower again. So this was the range that I had given out in the market outlook video. We are right at the middle point. So we can certainly come down to 2,500, 21,000, 20,000, form a new range, form a lot of volatility below 200 DMA. Meanwhile, the news keeps telling you about economic data, how India is not going to grow, the kind of problems the new US administration is going to build for the world. These things are not new. If you were in the market between 2021 and 2022, which was a painful 6-7 months of correction, you would have seen this before. Who is to say we cannot replicate the same thing that is happening here? That is why don't judge the market too soon. Today on social media, print media, news media, this is what you're hearing. This is probably a bull market that has turned into a new bear market. I personally don't think so. I would take that call only below this particular pivot that I've marked out. It's not to say you don't manage risk at these levels. Of course you do. But this is an opportunity. This is an opportunity that is going to be a painful one. Don't scale in quickly. Identify stocks that are having strong relative strength, belonging to strong sectors, strong pockets. Keep putting them in the watch list. Build a test portfolio, put in 1 or 2% of your equity and see what happens. Unless and until you are going to play this difficult game, you will not emerge as a winner. The people who want to sit out this particular phase completely are the same people who never ride this way on the upside. You have to be inside. No one is asking you to put your complete 100 rupees in the stock market, but put 5 rupees and see what is happening. Because that 5 rupees that you put in the market is going to become the most valuable indicator as opposed to whatever data you are checking on your apps, which at end of the day makes you impulsive, makes you think short term, and only makes that app provider rich. That is the truth. So as a retail player, you have a lot of flexibility to go in and out of the market. Don't do that with entire capital, but at least do that with 3%, 4%, or whatever your risk tolerance is, that percentage of your capital. That is going to be super helpful for you. So the only way we are going to know whether this is start of a major bear market is when price falls here, pulls back, and then again starts falling. That is why William O'Neill has written that bull and bear markets don't end easily. It takes 2 to 3 tricky pullbacks up or down to fake out or shake out the few remaining speculators. In this particular chart, if you look at the start of a cycle, people generally explore equities, a combination of equities and F&O. In this particular phase, where I think we are currently into, that is stage 3, you should be having no leverage. If you can protect your profits, if a lot of profits have gone, then it definitely means that you don't have sound risk management rules. Again, I know a lot of you won't like this, but if in this phase you have lost a lot of money, it means your risk management rules are not right. You need to go back to the basics, revise, and again come back. So whether we are entering this phase where FDs are more lucrative, or ETFs, or recurring deposits, or select stocks short selling, I don't know. Personally, I do feel that we are in a complex correction, and below this pivot I would be able to tell you, or in better words, if I see a pullback coming in the market, whenever it begins, the quality of that pullback will tell you whether this is beginning of a new trend, or we are again going to move lower after the pullback plays out. Do not forget this chart. This has played out in the past also. There are much more complex corrections that played out in 2011, 2015, 16 also. But for that, we need the market to stop and then stage a pullback. Pullback will come, guys. That is how market functions. Now, the third lesson that William O'Neill teaches during corrective phase involves a lot of prediction through indicators, and he has dedicated a chapter on it, and that is what we are going to study now. So lesson 3 is give market time to settle down. If you come back to this chart, if you see, there was a lot of time and price correction that played out. Even in this phase, though the volatility was not as similar to this, the chart structure was very similar. In this particular phase, if you see, time correction is playing out, price correction is playing out, but it is playing out with substantial amount of volatility, which means you will have to give time for the market to settle down. A big problem with indexes that move counter to the trend is that you always have the question of how bad things can get before everything finally turns. Many amateurs follow and believe in overbought and oversold indicators. The market was oversold all the way down during the brutal market implosion of 2000, that is the US market. Needless to say, I rarely pay attention to overbought, oversold indicators. What you learn from years of experience is usually more important than the opinions and theories of experts using their many different favorite indicators. Again, this is going to be super helpful because as Nifty 500 keeps falling, you will hear this in form of various data points. The put call ratio is so and so every time the market bounces from there. The stochastic indicator is below 8. This is where the market forms a bottom. The RSI is now 18. This is where market forms the bottom. Do not bottom fish. Even though I'm looking to buy in this market, whatever names I like, I'm not buying them today. I'm putting them on my watch list. I'm tracking. I'll see what price action plays out below 200 DMA. I will definitely update about it. And then I will take my own sweet time. The structure that there is, the kind of events that are lined up, don't bet a lot of money immediately. Again, lesson 3, give the market time to settle down. No one truly knows how much the market can fall. I'm working with this broad range. Who knows, this broad range gets taken out and we go and visit this level. That is why be patient. Be patient and give market the time to settle down. The fourth lesson that William O'Neill teaches is that even bottom-up market needs time. Now, in the Market 2025 Outlook video, I specifically told you that 2025 is not going to be the year of a lot of broader market index. It's going to be a bottom-up stock pickers year. Now, in this particular case where we are seeing Nifty 500, Nifty total market, almost every index correcting, is it the right time to go and bottom fish stocks? The answer is no, and that is something that we learned in the previous slide, which is the lesson 3. But I want you to read the specific parts in the book, because that is when you will understand why stability of broader market is so important before you even try to buy anything in the market today. You can be right on every one of the factors in the last 6 chapters, but if you're wrong about the direction of general market and the direction is down, then 3 out of your 4 stocks will plummet along with the market averages, and you will lose money big time, as many people did in 2000 and again in 2008, and I'll add again in 2020, which was COVID. If you're in a bull market, you need to know whether it's in the early stage or a late stage. And more importantly, you need to know what the market is doing right now. Is it weak and acting badly, or is it merely going through a normal intermediate decline, typically 8 to 12%? Is it doing just what it should be considering the basic current conditions in the country? Or is it acting abnormally strong or weak? To answer these and other vital questions, you learn to analyze the overall market correctly. And to do that, you must start at the most logical point. And that is why if you see the chart that I shared in the 2025 Outlook video of Nifty 500, this point I had taken as a starting logical point for the next 12 to 18 months. The reason being that this is where market had faced substantial amount of volatility in a 2-day period, which is about 10 to 14%. Many stocks were down 20-30%. I'm talking about the election day. So this becomes the logical reference point because this is the nearest major trending pivot in the market. And that is why at the beginning of the video, I told you that I would like to see what the market does in and around this pivot candle. All right, whether we are heading here to 21,000 to 2,500, then do we pull back again to 24,000? This move is going to tell you. And yes, today you don't kind of feel that the market can move up also, but that time will also come. Market is a game of patience and experience, and with these two skills, that is, if someone has patience and experience, there is nothing that one cannot achieve in the stock market. So these two qualities you need to have. You need to limit your time on social media for the next 2 odd months. You need to stop listening to people on a daily basis who give you daily updates about the market. That much information you don't need. Again, that is going to make you impulsive, that is going to make you short term in nature, that is going to put your trigger finger on either a call or a put. That is just how market functions. So one important point I missed out. If you see what he has written, is it weak and acting badly, or is it merely going through a normal intermediate decline, which is typically 8 to 12%? Now, currently we are between this. I think we are 10.5% or 10.8% down. Let's see if we hit the 12 to 15% kind of a criteria. There are a lot of new players in the market who have come post-COVID. This is the first time they are seeing such a decline. I personally felt the 2021-2022 decline was relatively straightforward. You are not seeing that kind of pain that you're seeing today. So this is a good challenging phase in the market. Don't be shy from this particular phase. This is a phase that makes amateurs pros in the market. This is a phase that distinguishes between men and boys. So this is an important lesson that market is teaching you. Even if you've lost money, don't lose hope. In stock market, ups and downs do happen. But if in this particular cycle you were not able to protect your profit, then it's fine. But if you're not able to protect your capital, then your risk management rules are not fine. You need to go back to the basics. Now, the fifth lesson that the market, that is William O'Neill, teaches you is that volatility in a mature bull market is a norm. And that is how market functions. The really big money is usually made in the first 1 or 2 years of a normal new bull market cycle. It is during this period that you must always recognize and fully capitalize upon the golden opportunities presented. In September 2024, that is 2.5 years after the amazing bull market that we saw, that is between 2021 and 2022, then we had a minor correction, and then 22 and 23 again was fantastic. In September 2024, I had made a video that many people did not see. The title was that the easy phase of bull market was over. And that particular video was because that time I was revising the notes that William O'Neill had put out in his book. The rest of the upcycle, and this is where it gets interesting because you need to know where you're today. The rest of the upcycle usually consists of back and forth movement in the market averages followed by a bear market. In the first or second year of a new bull market, there should be few intermediate term declines in the market average. These usually last a couple of months, with the market index dropping from 8% to an occasional 12 to 15%. After several sharp downward adjustments of this nature, and after at least 2 years of a bull market have passed, heavy volume without further upside progress in the market daily market averages could indicate the early beginning of a next bear market. Now, the phase between 2020 and 2022 was fantastic. It's in 2022 where we started seeing volatility and pullback. Then again, this next 2-year phase was easy. And that is when the corrective phase has again begun. So every 2 years now, we are seeing, especially in our market, given how global liquidity is, that we get challenging times after 18 to about 26 months. And that is the challenging times that we have again faced currently. The headlines are not great, guys. A lot of bearish data points are turning up. But I would tell you that give this market, with what you've learned today in William O'Neill's priceless kind of lessons that he's taught, give this market some time before you start to judge it. I know at this particular phase, a lot of people will be hurting, but take it as a lesson. Take it as a lesson that this phase is also a reality in the market. This phase is also a phase where market will take away money from you that you made in the previous cycles. But unless you navigate through these phases with very limited capital, with better risk management rules, you will never live to fight another day. You will never live to see this kind of movement, to see such waves in the market. To make it big in the game, you will have to play the game. You cannot sit on the sidelines. You cannot be short sighted. You cannot be scared. Have a better defensive game in the market. That is, your risk management rules have to be in a way where you don't lose a lot of money in the market. There are many a times I've mentioned this. I've read so many books where they have written that a 30% or a 25% drawdown from your capital is fine. That is how markets function. No, it is not fine. William O'Neill has taught a rule where he used to exit his portfolio the moment it was 7% off from his average buy price. That is to protect capital. Because if you lose 30% of your capital, I think it will take you 42.2% gain to make that money back. If you lose 50% of your capital, it is going to take you 100% profit, that is gain, to just recoup your capital. So the less you lose, the more you make when such phases come in the market. Yes, today it's difficult to see that. Today it is so painful. I think Monday we will again gap down. Tuesday we'll have a lot of volatility. Wednesday I'll have an update for you at around 7 p.m. A quick 5-minute update. But this phase is not going to end. It's not going to end soon. The budget is coming. The new US administration is coming. In between we have the federal meet again, RBI policy again. There are a lot of events lined up. So take it one day at a time. So don't lose hope. I will continue to update about what is happening in the market. Follow me on Instagram because that is where I can post charts easily. I'm not active on X that much. You can understand why. So have a great weekend ahead, guys. Take care, be safe, and I'll see you on Wednesday.